UTI S&P BSE Low Volatility Index Fund. Can this fund help you create long-term wealth? Who can invest in this fund? Who should avoid this fund? Let us explore. Hi, this is Ramalingam from holisticinvestment.in. We help individual investors like you to take right financial and investment decision so that you can reach your financial goals faster and smarter. Before reviewing this fund, we have to understand the basic structure of this fund and the strategy of this fund. The NFO is open till 25th February. The key features of this fund: it is an open-ended fund having a benchmark as BSE Low Volatility Index. This fund has got no entry load and no exit load. What is the investment objective of this fund? Because this is something very much important to evaluate this fund. This fund will simply mimic the BSE Low Volatility Index. So this fund aims to deliver same return as of the index, subject to tracking error and expense ratio. So this is a simple plain vanilla investment objective of this fund. What is the investment strategy? This scheme is a low-cost smart beta index fund that tracks the S&P BSE Low Volatility Index passively. Yes, passively means they are going to simply mimic or replicate the index. And low cost, obviously it is a passive fund, so fund management expenses are low. It is a low cost fund. Smart beta index fund. What is mean by smart beta index fund? It is a low volatility index, so it is a smart beta. The beta will be less in this fund. And one important factor which we have to understand about this particular index is this index in the long run has outperformed BSE large mid cap index. This is an important factor to consider. The top holdings are well-known companies diversified across multiple sectors like consumer goods, automobile, chemical, information technology, pharma, financial services. As we have understood the basic structure of this fund and strategy of this fund, now is the time to analyze the pros and cons of this fund. What are all the findings in favor of this fund? Advantages to this fund. As I told you, this invests in multiple sectors, so it is a well-diversified fund. And as these companies are like large cap companies as well as some mid cap companies are there, well-known companies, which will generate good economic value over a long period of time. Obviously, this fund is suitable for ultra-conservative investors looking to add passive investments to their core equity portfolio. Compared to an actively managed fund, the returns from this fund will be relatively stable and less volatile because it is going to be simply mimic the index. They are going to replicate the index. So they will be performing in line with the index. They will not outperform the index or like underperform the index with a huge margin, not possible. This fund is not having any stock selection risk because this buys the entire index. So there is no room for fund manager bias. Fund manager picking and choosing some stocks and it is going against this fund and it is not working and it is giving poor returns to investors. No such risk in this fund because this buys the entire index. Generally, it is observed that low volatile companies represent relatively stable businesses with strong fundamentals and business models. Because it is a passively managed fund, fund management expenses are very low, so this will have low expense ratio. We have looked at length the advantages or observations in favor of this fund. We are going to look at the findings and observations which are against this fund, which are drawbacks, potential demerits of this fund. Let us evaluate that. This is an equity index fund, so it is not suitable for short-term investments, obviously. Being an index fund, this can outperform the respective index because of the expense ratio, because of the tracking error, and because of the other costs. It can underperform the respective index. As this is replicating and mirroring the index, they will not beat the market, which is not possible. Whereas in an actively managed fund, the fund manager can pick and choose few stocks out of the index. They have scope to outperform the index. Here it is not possible for this fund to outperform the index. Not possible. Based on the market outlook, the fund manager cannot change the allocation dynamically. Say they are investing in large cap and mid cap. This fund is not going to invest in small cap. So, whereas in a diversified equity fund, fund manager can move from large cap to mid cap to small cap based on the outlook. Similarly, in a diversified equity fund, fund manager can move from one sector to other sector. If the information technology sector is going to do well, the outlook is in favor of them, then they can have higher allocation to that sector. After some point in time, the outlook changes and becomes brighter for pharmaceutical sector. Then they can reduce the exposure to information technology sector and move to pharmaceutical sector. This is not possible with this fund because this fund's mandate is to simply replicate the index. Whatever is the weightage given in the index, that will be blindly followed, not based on any outlook, not based on any analysis. They'll be giving you allocation. And what are the stocks they are going to buy? They will not analyze the fundamentals of the fund, soundness of the stock. They will not analyze. They will not analyze the sustainability of the company. They will not analyze. They will not analyze the profitability of the stock. No. This fund simply buys the entire index at the same weightage without looking at any analysis of the fund, of these underlying stocks. So this may work against you as an investor. Active funds can take more calculated risk in the index. Whatever is really having good outlook, they can pick and choose in their calculation. Whatever is giving better risk adjusted return, they can choose. Whatever is having low risk adjusted return, they can avoid. It is possible in an actively managed fund, whereas in this index fund, it is practically not possible. They have to simply mimic and mirror the index. So we have to take blind risk, blind faith on all the stocks in the index is given. And tracking error is another important drawback of index fund. They will not perfectly will not be able to give index returns. When the market is going up, touched all-time high, or when the market is crashed, this fund will not take any course correction. Market has crashed, so let me convert the stocks into stocks which can pick up and have aggressive growth before the market recovers. Not possible. When the market has touched all-time high, there's a possibility of correction or crash is there as an outlook. Then the fund manager will, in an actively managed fund, he will change it to conservative stocks. Whereas here it is not possible. They can't change from conservative stocks to aggressive stocks to conservative stocks based on the market outlook, market all-time high or market at all-time low. It is practically not possible. We have analyzed the two extremes of advantages as well as disadvantages of this fund. Now is the time to finally decide whether to invest in this fund or to avoid this fund. To invest or avoid depends on you as an investor. What kind of investor are you? It is dependent on that. Yes, this fund is suitable for ultra conservative investors. First time who's investing into the stock market, who is not at all comfortable. He wants very safe takeoff in stock market. Then in that case, like this fund can be uh, good option for them. This is definitely suitable. Who's not willing to invest in actively managed funds, because actively managed funds has got more potential to deliver better returns over index funds. Someone is not willing to invest in actively managed funds and a first time investor or an ultra conservative investor, then for them this fund may be suitable. However, there is one particular challenge is there are similar index funds that have a lower expense ratio and lower tracking error. Right? That means the ability of this particular NFO fund, UTI BSE low volatility index fund, to deliver less tracking error and less expense ratio have to be tested. The ability to deliver low tracking error and less expense ratio is not yet tested. We have to wait and see the track record. Whereas there are existing funds with track record. Even a first time investor or an ultra conservative investor, they can choose this existing funds instead of this fund. Actively managed funds have better potential, more potential to deliver a higher return than this fund. If you are an if you are an investor who's looking for dynamic fund management or looking for investments which can beat the market, then this fund is definitely not suitable for you. If you are not still clear about whether to invest in this fund or avoid this fund, which category you belong to, then obviously you can consult a financial planner if you are in doubt. If you are looking for a free initial appointment with our financial planner, the link for the free appointment is given below this video in the description box. You can register for the free appointment using the link given in the description box. The detailed analysis of this particular fund is available as a blog post. We have done an in-depth research about this fund. It is available in our blog post. The link to that is also given in the description box. Please click and read the entire article. Would you like to attend insightful investment webinars? Then we organize regular investment webinars. The upcoming webinar link is given below this video in the description box again. Please register for the next webinar and discover a lot of investment principles and techniques to create wealth. Last but not the least, if you like this video, please give a thumbs up. If you have friends who will be interested in these kind of videos, please share it with them. Please subscribe to our YouTube channel so that you will not miss any of our future videos. Bye. Thank you.